And we're back. So we're now focused on the cost that deals with the finished goods inventory. Can those costs be shown as an asset or an expense? Let's begin with the product cost. The cost to actually make a product. That's your material cost, your labor cost, and overhead. These costs remain in the inventory account an asset until revenue is earned when the inventory is sold. So in essence, when you first acquire these costs, the cost goes into an asset account known as finished goods inventory. When a product is actually sold, you're going to recognize revenue from the actual sale of the product based upon the sales price. And you're going to have an expense known as cost of goods sold that you're going to hear about later. Costs that are not classified as product costs or known as period costs and are going to be expensed in the period in which they're incurred. Those include general, selling, and administrative costs, interest costs, and the cost of income taxes. So now we're saying if we have an actual store, your rent expense, your sales salary expense, depreciation of store equipment, advertising expense, those are known as period costs, and they're going to be expensed right away. So product costs are shown as an asset until the product is sold. Your period costs are going to be expensed as those costs incur or take place. So remember the $1,000 that we said we spent to make those 4 tables? That initial cost is going to be shown as an asset. All right. The cost of the finished goods is shown as an asset. So if you remember, there were 4 tables that we produced. Let's assume that we sold 3 of those tables. Well, the cost of those three, 250 each times 3, 750. Now because they've been sold, that 750 goes on the income statement as an expense known as cost of goods sold. The remaining table that's not sold goes to your ending inventory for the 250, and that's shown as an asset. Assuming we spent $200 for selling and admin costs, those costs are going to be expensed as they incur or take place. We'll now see how does manufacturing product costs affect our financial statements. So here we have a list of transactions. Number one, we issue shares of stock. So cash increase, your common stock increase. The next transaction, we actually purchase or produce inventory. So the cash account decreased, the inventory account would have increased. Number three, we had an expense of some sort. These are from previous chapters. So the cash account decreased and retained earnings decreased. For number four, we exchanged cash for more inventory. So a decrease in your cash account, increase in the inventory account. Number five, we bought office furniture. So the cash account decreased, office furniture account increased. And number six, we recognize depreciation on the office furniture. So the furniture account decreased and retained earnings decreased. Next, we manufactured equipment. We bought manufacturing equipment. So our cash account decreased. The equipment account increased. Next, we recognize we purchased inventory. So the inventory account increased and the equipment account decreased for number 8. And then for number 8, here's our transaction when we just purchased the inventory. So the inventory account increased by 1,000. The equipment account decreased by 1,000. And here you see the total sum of all of these transactions on your financial statement. Okay? We're going to now break down those components that make up product costs, your raw materials, what we call your work in process, and your finished good. Let's begin with raw materials. So raw materials are those items we're going to purchase that we need to make the actual product. They go into a raw material inventory account. So let me ask you this. What if you were trying to produce, again, those tables? You would need private items like wood will probably be your main source of raw material. All right. Now, once we sell the goods, the cost is transferred from the inventory account to an expense account known as cost of goods sold. Now, material cost is only one component of the total manufacturing cost. Now, we got three components. We got material cost, work in process, as well as raw material. Okay? So now let's look at work in process. The salaries paid to our seller and admin employees, these are event 3 and 4 that we just took a look at. The salaries paid to these for who work to make the actual product, their salaries will go into your work in process inventory because it's part of your product cost. In contrast, salaries paid to those who work in selling and administrative expenses, we call those a period cost, and they're going to be expensed right away. So the production wages are added to the inventory account, and they're going to be expensed as part of cost of goods sold once the inventory has been sold. All right. So these product production workers' salaries is known as your direct labor cost. So here we see the actual graph. The production wages goes into the inventory account on the balance sheet. Once the product is sold, those wages now are part of your cost of goods sold account compared to the selling and admin expenses. Those are going to be expensed right away on the income statement as they take place under an account known as salaries expense. Okay? Depreciation cost total $1,600. $600 was on office furniture and $1,000 on the manufactured equipment. So now you're asking yourself, here we have this depreciation cost. We're asking what portion of the cost will be product cost, what portion will be what we call period cost. Well, the 600 office furniture had nothing to do with making the actual product, right? So those costs will be a period cost. They're going to be expensed right away on the income statement. But the depreciation on the manufacturing equipment, this would be part of our overhead costs. That 1,000 will first go into the inventory account to increase your product cost. And then once the item is sold, it will be shown as cost of goods sold on the income statement. So initially 1,000 will be shown on the balance sheet as inventory cost, but then once you sell the product, that cost becomes an expense known as cost of goods sold. So here we have depreciation on manufacturing equipment. First goes on the balance sheet and the inventory account. Once it's sold, it's shown at an expense known as cost of goods sold, but the alternative depreciation will be expensed right away on the income statement as your depreciation expense. Okay? Let's look at some schedule of inventory costs. Here we have our material costs, our labor costs, and our overhead costs. So the total product cost was $6,000. The overhead cost was for depreciation. In this case, the cost of the equipment was $4,500. It had a salvage value of $1,500. The difference is called the depreciable cost is $3,000. The equipment has a useful life of 3 years. Therefore, we're going to expense $1,000 each year. So the $1,000 is the depreciation on the equipment used to make the actual product. So our total product cost was $6,000. Assuming that we sold some of those products and the cost of goods sold was $4,000, the remaining cost of $2,000 will be the ending inventory shown on our balance sheet. So total product cost less cost of goods sold equals your ending inventory balance. So now let's take a look at a partial income statement, actually the complete income statement. Here is the actual sales revenue for the sale of those products. That was $7,500. The cost of goods sold shows how much we paid to make those products that were sold. That cost was $4,000. They gave us a gross margin of $3,500. Next, you have your operating expenses for salaries and depreciation that total $1,800. Remember, those are going to be expensed right away. And the difference between your gross margin less your operating expenses gave us a net income in the amount of $1,700. On the balance sheet, you're showing your cash in the balance, your finished goods inventory. Here we have the office furniture less any accumulated depreciation. Same for the manufacturing equipment. Remember that cost less accumulated will give the book value for the office furniture and for the manufacturing equipment. Total assets 16,700. This problem we do not have any liabilities. Under the equity section, we have common stock 15,000, retained earnings 1,700. Our assets equal our liabilities plus our stockholders' equity. Okay, so let's break it down even further. So the 4,000 cost of goods sold reported consists of your material costs, your labor costs, and overhead costs, also known as your product cost. And similar, the 2,000 finished goods inventory on the balance sheet also consists of your material costs, labor costs, and your overhead costs. So initially, your product cost is classified as an asset, but once it's sold, that cost now becomes an expense. In contrast, any selling, general, and admin expenses, again, advertising, salary for your sales staff, insurance on your office building, those costs we call period costs, meaning that they're going to be expensed in the period in which they incurred or took place. Okay? Indirect costs. What are those? Indirect costs are costs that cannot be traced to products and services in a cost effective manner. So remember, for this example, we're making those beautiful tables that we saw. So with those indirect, making those tables, now we're asking what we consider indirect costs. Well, there could be items such as, so the wood to make the product would be a direct cost, but there could be small items such as screws and nails put in the table that we cannot trace to a specific product. Those are known as indirect costs. Well, those indirect costs are going to be included in your manufacturing overhead. So items such as indirect materials, so those would be material we consider to be insignificant. I mean, they're needed, but we can't trace those to a specific product because we may have bought a whole bunch of screws, nails, other small items. Indirect labor. So let's say that we have a warehouse and there's a security guard that works inside the warehouse. Well, that's labor, but we call that indirect labor, meaning that we can't tie in that salary to a specific product. Utilities for the factory, rent of the factory, depreciation. These are what we call manufacturing overhead costs, and we're going to assign a portion of these costs to what's known as your product cost. All right, so all these items make up what's known as overhead costs, which is a portion of your product cost. So we're going to come back and look at an example of an indirect cost allocation example. Okay, stay tuned for our next video lecture. Bye-bye.